Craig Hask with the Value Hunt Academy. You're listening to another exclusive interview with a leading authority in the opportunistic and value real estate investing space. There are many real estate brokers and other service providers looking to get in the game of buying and syndicating value-add properties, but can't seem to pull the trigger. To give you some insight on how to buy and start and syndicate your own value-add deals, we are speaking with Patrick Wakeman, founder and principal of CALCAP Advisors. Pat got started like many new syndicators, working as a commercial real estate broker for a large firm. Pat and his two co-founders would dream about one day buying and syndicating their own deals. In 1998, Pat and his partners finally got started. Last year, Pat bought and syndicated 5 mid-sized value-add multifamily properties totaling 255 units. Pat shares with us the steps he took to finally get started to realizing his dream of buying and syndicating his own deals. Also, Pat walks us through a value-add multifamily property he bought last year, where he renovated it and is now selling it for a nice profit. You're going to love this unique story. In this interview with Pat, you will learn how he raised money for his first deal, how Pat uncovered hidden value on his 64-unit multifamily project, the 4 things he looks for in a great deal, how to overcome your fears to start your own syndication business, 3 tips to make fundraising easier, how he profitably repositioned a 43-unit multifamily property, the big lessons he learned on his first deal. This interview is loaded with lots of real-world nuts and bolts information on how to finally get in the game buying and syndicating value-add properties. Do yourself a big favor and set aside some time to listen to this high-value interview with Patrick Wakeman. All right, Pat, so you're an active investor and a syndicator of underperforming mid-sized apartments, and I kind of want to talk to you about your business model. How are you capitalizing on today's distressed market?
So CALCAP Advisors has 3 partners. It's my partner Ed Alloy, Mark Mazzillo, and myself. And we started it, CALCAP Advisors, at the end of 2008. We had been friends for a long time, about 25 years. We went to college together at University of San Diego. So in 2008, we started CALCAP Advisors with the strategy of repositioning distressed assets and also starting up a lending platform, a private money lending platform. So that's what we've been doing since 2008, and that's continued to be our strategy. From an equity side, on the apartments, we own in California, Arizona, and Texas. And right now we're doing almost all of our buying in Phoenix of apartment buildings, anywhere between 50 to 250 units. And so we're looking for distressed ownerships. We're looking for bank REOs, note sales, short sales, trustee sales. We're looking for distressed properties that have vacancy, poor management, deferred maintenance. And, simply our strategy is to buy those properties, generally all cash, quick close, address the issues that we see that need addressing in the property, stabilize the asset, and then recapitalize the asset via, a refinance or a sale. We generally say we're going to hold the properties for 3 to 5 years, but over the years we've held properties for as short as 90 days, and we've held properties for 9 or 10 years. So, but in general, we look for a 3 to 5 year time horizon over an investment, and we're looking for returns that are going to pay an investor somewhere between in the mid to high teens on an annualized basis. So 15 to 19% is sort of where we target.
I mean, there's certain types of challenges you're having as you're out there executing and trying to find these deals?
The first challenge, obviously, is finding the deals. And there are more buyers coming into Phoenix, is what we're noticing. So there's more competition. There's more offers to compete against. Almost every deal we offer on now will have an initial call for offers and then a best and final phase at the end of that. And it's not unusual to have, I'm sure, 8 to 12 offers in most cases that you're competing against. So that's the difficulty right now, is sourcing quality deals, making sure you're not chasing it too hard to overpay for those deals, and just watching your returns.
Well, you're in the process of growing your business, and you've been expanding. Like in 2011, you purchased roughly 5 properties totaling 250 units. What types of things have you done that has helped you grow your business?
What we've done is, when I think of growing our business, I think of acquiring more buildings. So the very first thing you have to do with that is you have to keep good relationships with brokers in that local market. So of those 5 transactions that you mentioned last year, every single one was purchased through a broker, sourced through a broker, and so keeping broker relationships good those brokers will see a lot of deals and a lot of deal opportunities. So we talk to almost every broker in town, and we try to have a good relationship with those brokers. The second part of that is when they bring you an opportunity, you have to perform on it. You have to close on it if you say you'll close on it. And once you get the reputation in town as someone who can perform and close on a transaction, that really opens up a lot more deals that tend to come your way. So once you get the momentum going, you tend to see more deals. So the momentum from our standpoint is now we're building the portfolio to a size where we're getting equity investors interested in what we're doing at CALCAP Advisors. We are communicating with those investors. We do extensive investor reporting. We do monthly e-newsletters. We do all kinds of things to let them know what we're up to. And the other thing I would say is once you get that portfolio going, you can add to your team and get even better at what you do. So, for example, in the last 4 or 5 months, we've added a controller to the team. We've added a full-time repairs and maintenance supervisor to the team. That's in addition to our property managers, our leasing agents. And so now we're frankly better than we were a year ago as someone you would want to, co-invest with. So, we've made it over the hump. We're seeing a lot of deals, and we're communicating with our investor base and trying to find more for them.
I just want to tag you there on finding deals and working with brokers. It's so important because I've noticed that, when real estate brokers get paid on performance, they get paid when a deal closes. And there's a lot of guys out there trying to buy deals. And when someone actually closes a deal, now you're for real, and brokers want to spend more time with you because they know you closed the deal. And so you actually end up seeing more deals, just like you talked about. Yeah, completely agree. I mean, almost like anything, the first 1 or 2 deals are maybe the most difficult because you're an unknown entity, but once you get a couple closings, and the people who take note of those things are brokers in the local market, so they're going to pay attention to you and start wanting to know what else you're looking for. Well, Pat, let's talk about a deal that you closed, 64 units towards the end of last year, and it had a value-add component. Can you tell us about the opportunity, kind of how you're going to create value? Okay, that was Casa Nova Apartments. We bought that on December 16th, 2011. It was a Wells Fargo REO, and we bought that for $2.1 million for 64 units. It was about $34 or $35 a square foot. Interesting value-add component on this deal, because I think your standard value-add is, paint the building, improve the landscaping, and do your basic management things to make the project much nicer for your residents. Well, in this case, this project was built as a partially affordable project. So a group called Community Services of Arizona had built it and had 26 out of the 64 units deeded affordable, so they had affordable restrictions on them. What was interesting from our standpoint is when Wells Fargo foreclosed on the loan and became owners of the property, the deed restrictions were removed for the affordable component. So what we had there is an opportunity to take 26 affordable units and take them to market rate as they turned over. So right there's $150 to $200 per unit right off the bat in just taking a unit from affordable to market rate. So there was an opportunity there. The other thing that was interesting versus a lot of projects we see in Phoenix is this project, it was a
for under 100 units, you didn't see many projects built in the early 2000s. The early 2000s in Phoenix, you saw a lot of institutional 300-unit complexes, but you didn't see a lot of 60 or 70-unit complexes. This was sort of rare and unique. So we saw something that was recently built, had a fantastic mix of mostly 2- and 3-bedroom units, and yet we could take, a third, almost half of the project up to market rents within a fairly short period. And so that was the attractive thing for us. We closed on that at the end of December, and I can tell you raising money on that one was, fairly simple.
Right, because it was a great deal.
Yep.
But you also had some value add in this deal in that you got a great price on it, because I know you negotiated hard on it.
We did. We negotiated hard in that we were just about ready to go under contract on this in 2011 at the very end of summer. And we were, if I remember, we were about ready to go under contract at about $2,450,000. I believe that's the number, $2,450,000. And in the end, as we were getting ready to sign the contract, we just felt we were chasing the price a little bit. We didn't feel it was quite worth that, and so we decided not to execute the purchase agreement, figuring, well, someone else is going to, find a way to buy that deal. But after 3 months, the third buyer in on that deal had canceled out, and the brokers came back to us and said, essentially, the lender would like to get this off the books by the end of the year. Can you close it by the end of the year? And we said yes and we negotiated the price to $2.1 million, and we made a deal and closed it on the 16th.
Love that story.
Yeah, I love it when properties, when you hold the line on valuation, you know what makes sense, you know what you can deliver, you know how the property's going to operate for the most part, and you hold the line and, common sense prevails and the property comes back to you. We like that too.
Yeah. So, Pat, you're out looking for deals. You're trying to find opportunities where you can execute your strategy. When you're out looking, what's the perfect deal look like? What are maybe 3 or 4 things that a great deal's got to have?
Okay. Perfect apartment deal for us would be a B or C property that was built in the 1980s or later. So, we're not going to chase an A property in Scottsdale. We're not going to chase that institutional property because there's a lot of money chasing those deals right now, and they're paying, very low cap rates on that stuff. So we don't see enough value add in that niche. So we're going to go after a B and C property built after 1980. We're going to look for an attractive price per square foot first and foremost. So, people look at cap rates in the income approach and price per unit. We're more or less focused on price per square foot as a metric. We're going to look for a good mix, of course. We're going to look for a good mix of 1 and 2 bedrooms. So, maybe ideally a mix might be 1/3 1s and 2/3 2s, or half and half, something like that would be a good mix to us. It goes without saying we're going to look for a good location that's, for us, we look for something that's in a good submarket, fairly close to employment and transportation. And then I'd say finally, the other thing we look at is we tend to always look at the transaction history for each asset we're looking at. So, Phoenix itself is a cyclical market, and there are highs and lows that you become familiar with in that market from a timing perspective. So we'll look for what did the asset sell in the early 90s, the days of the RTC. What did the asset sell for in that time period? And conversely, what did it sell for in between 2004 and 2006? And we'll just pay attention to where it's gone and where it's been. So we know with our metrics that typically the product we're looking at is going to sell for probably 50 to 60% less than the peak. So if a property sold in 2005 or 2006, generally where it's going to be priced today is 50 or 60% below that. And then we'll compare that to perhaps, how it traded in the early 90s as well.
Yeah, it's interesting to say that because here in Phoenix, for sure, we've had 50 to 60% drops in prices, but on the other side, it's such a high-growth area that it's very likely that we'll recoup a lot of those values over the next 3-4 years.
We agree.
Yeah.
We agree with that, yep.
Well, Pat, you got a great story, and I kind of want to drill down on how you got started, because a lot of the members here at Value Hound Academy kind of started the same way. They're commercial real estate brokers, and they eventually started to raise money to buy their first deal. Can you tell us how you actually got started?
Sure. As I mentioned, there are three partners at CALCAP Advisors, and my partner Ed Alloy and I are both former CBRE brokers, CB Richard Ellis. And you know, what we would do when we were young and just breaking into brokerage is we would sit down and sort of plan how we were going to own buildings someday. We already knew we were brokering buildings, selling, leasing, but we would sit down and plan how we were going to own buildings. And then the RTC period hit in the early 90s in Southern California, which I would say that was from 1991 to 1994, which were sort of the depths of the RTC crisis. You know, during those days, we were just surviving and getting by. But once we got through that time period, we started planning again about how we were going to own buildings and build something. So we started in 1997 by pursuing an 8-unit deal in Escondido, California, which is North San Diego County. And we pursued this little 8-unit deal. And we worked really hard on it. We, wrote the offer, did physical inspections, looked into financing, did all the market surveys and comps. And at the end of it, the deal didn't close. The physical inspection just didn't check out to our standards or to anyone's standards, frankly, after we got through with it. But we had done the whole cycle of everything else, and we started to really get confident that we could do this, that it wasn't rocket science, that we could do this. So the next deal that came along, as we started looking at more and more deals, we were ready, and the next deal that came along was a 27-unit apartment building. That was in Palm Springs, California. And, we got 5 friends, and the 7 of us invested, and, that's just how we got started right off the bat. And so anyway, we started small. We failed, I suppose, on our first deal. We even put out an offering on it, on a small, like $300,000 deal. And but we learned the process and stuck with it. And the next deal that came along, we got done.
And I know you believe in starting small. Why would you say that's important?
Well, for your listeners, for the listeners who are there, I look at on the website, your advisory board, those members are all very accomplished, and I don't know what they would say, but what I would say is from a perspective of starting out, you're going to have to cut your teeth on some deal, and it's just too unlikely that you're going to step right out and go do a $10 or $15 million institutional deal yourself, that you're going to raise that equity, that you're going to have the capacity to attract capital, manage, and I just think it's so highly unlikely that, people who start with single-family residences and flip those, or start with small apartment buildings or small commercial buildings, I think you just have a lot better likelihood of seeing some early success. And so much of this job is learning on the job. So if you're constantly working on big deals that never make, you're going to learn some things, but you're not going to learn anything about operating it because you're never going to own it. So you have to own it. You have to own something. You have to buy it. And for that reason, I think just starting small makes the most sense to get going. You can always build up, but it's really hard to, hit that home run in your first swing.
Yeah, that 8-unit deal you did or tried to do in Escondido, that was a small deal. You learned a lot from it, and it helped you obviously do your bigger deal in Palm Springs.
Right, exactly. And we still look back and laugh about that deal, about, how we worked it, but we made the right decision also by not moving ahead, and then we just stuck to it and had perseverance.
Well, I know raising money is a big fear for new investors, in some cases a little bit more sophisticated investors. How did you get started raising money? I think you went to some of your coworkers at CB, and they helped get you going, but can you talk to us about that?
Yeah, you're right. It was very organic. We went to friends and family, just like I think how most sponsors start. They go to friends and family. They come across an opportunity that's a good deal, and they start going to people they know and trust, and people who trust them too. So from our standpoint, I was at CB Richard Ellis. Ed was in the lending industry at that time, which was starting to take off. 97, 98, things were starting to get a little bit busier there. And we had gone through underwriting and potential financing, due diligence. We understood leasing and sales. We had worked hard. We had a story to tell. We had some expertise. We had a story to tell. And we were always scrounging around for good opportunities, calling on any opportunity. So as we found a good opportunity right at the beginning of 1998, we were ready. We had done some of the homework and preparation that you needed to do to attract money and to have people not laugh you out of the room when you say, I think we should buy this 27-unit apartment building. So it really started with the very basics, friends and family. We got 7 of us to invest in this apartment building. I remember we put $165,000 into it. We got a loan for some portion of it. And I think 6 years later, we cashed out with about $775,000. And so, we earned a really healthy return, and everyone was pleased that they had made the investment. And then again, as we talk about with momentum, once you start doing one deal, it gets easier to do other deals. So the second deal we bought was down the street from this 27-unit building because we were doing due diligence on the market, and we found another building that was distressed and needed something. So again, just getting started with a small or medium-sized deal is there's nothing wrong with that.
It's the hardest part too, is to get going. Would you agree?
Yes, sure is.
But once you get going, all of a sudden you got excitement. Your investors got excitement. They want to see the next deal, and just kind of builds on itself.
Right, exactly. And people are interested in what you're doing, and they're receiving distribution checks, and they thank you. Hey, thanks for that check. I got it. Thanks for the investor report, giving me an update on what's going on. And it does build on itself, and you start getting referrals, and then you become more confident in approaching people about what you're doing, and you can, state your case and tell a few stories. You have case studies to discuss. So you become an expert. And in this business, you're learning something every week. I think you still learn something about operating, acquiring, disposing, whatever. You learn something every week in this business. So, cumulatively, you just get better and better as you go.
Well, how about a couple tips, maybe 2 or 3 tips that you've learned that's helped you be successful and grow your company that you might be able to pass on? Okay.
I would say tip number 1 is, for us, it all starts with the deal. So you're going to really struggle if you have a marginal deal to talk about with people. So you need to prepare. You need to become knowledgeable about the market, about sale comps, lease comps. You need to do your homework and get prepared on your niche, on your submarket, on your product type, and you really do need to find a good deal. First of all, you don't want to put your own money into a marginal deal. Nobody else does. Think about it. So, it starts with the deal, and we've always had a pretty firm conviction that if we find a good deal, the money will come. We could always invest a portion of it on our own, but to finish out the equity raise, we always said a good deal will attract the money, it will find money. So first and foremost, my advice would be secure a good, sensible deal that you can explain in 5 or 10 minutes about why it makes sense. That's so important. Don't waste your time on marginal deals. You'll just spin your wheels. You'll spin your wheels quite a bit. And then, step 2, once you find that good deal, let everyone know about it. Let them know what you're doing, what your plan is to execute at the property, and why you can do it. And you really have to be pretty open about telling people what you're doing. And I think it's so much easier now than like 15 or so years ago with all of the technology that we've got now. It's much easier to let people know what you're up to and what you're doing as opposed to back then you had to call them actually. So, those are, basically step 1 and 2. Find a good deal and let everyone know about it, and just let them know what you're going to do, your plan, how you're going to execute it. It's fairly simple, and then just have integrity, answer questions honestly, show your integrity in, dealing with brokers and other people involved in the transaction, and just let them know that that's the way you proceed on things. And, people are going to ask questions about deals, and they're going to find holes in deals, things they don't like, perhaps. But, always answer with integrity, and there you go. There's your three-step basic right there.
Yeah, those are great tips, Pat. I really appreciate that, because I wholeheartedly agree exactly what you said. You got to find a great deal and let people know about it. I want to spend a few minutes really digging deep into a deal that you bought basically a year ago. It was a 43-unit property in Phoenix. You renovated the property, you leased it up, and you're in the process of selling it. And I want to go through the process of kind of what you went through when you saw the deal, the opportunity, and where you're at right now. Can you kind of walk us through that property?
Mm-hmm, sure. The property that you're talking about is Coronado Gardens. We bought that at the end of March in 2011, March 31st, 2011, I believe. 43 units, and we bought that for $975,000. Let's see, on a per unit, I think that was $22,000 per unit, $34 per square foot. Again, that's a metric we're finding around $35 a foot. That's Craig. That's right where we're finding the B and C property market right now in Phoenix. So anyway, we purchased that property at the end of March, and this was a private REO. It wasn't a bank REO, but it was a private note holder who had purchased a note and foreclosed on the property. So again, it fit into our distressed model. It fit into a property where we saw some potential that was going through some distress, and that we thought we had the expertise to turn around. So we purchased the property. We set aside on this deal a $250,000 rehab budget, which was going to be spent primarily on exterior issues, pool, and other things. And then we were going to have, I think, about $60,000 or $75,000 for interior turns. And then we were only going to do a portion of those turns and finish out the rest upon turnover. That was sort of the plan on that deal. The background on Coronado Gardens was it was the worst-looking property on a pretty nice street in a good submarket, sort of that downtown uptown area of Phoenix, right down the street from the Phoenix Art Museum. Very nice street, quiet little buildings, except for sort of this dumpy-looking building on the corner, which was ours. And as we were beginning to figure out exactly what we were going to do, we knew we were going to need a local contractor to, make our plans happen on that building. And that's when we met a local contractor and artist, and we were really fortunate to meet him. We were introduced to a guy named Bill Tonneson. Bill came in, invited us to his office and his home in Tempe, and we really got a feel for what he liked to do as a contractor, as an artist, with all of his unique touches. He toured us around a few of his buildings that he had worked on and really demonstrated that he had a very good handle on what needed to be done at Coronado Gardens. So we hired Bill, and from there the project sort of took off and got new life. I credit Bill with a lot of the added value at Coronado Gardens because he did a fantastic job on the rehab. Bill came in with a lot of passion, and he wanted to add a cool factor that certainly wasn't there at the asset. And the cool factor is we transformed the pool from a regular pool to a saltwater pool. We did Wi-Fi throughout the property. We did all new signage, all new identity. Bill did some custom sculptures for us, which are provocative, I will say. It was in the news, so you may have heard about it. A lot of custom artwork throughout the property. Bill outfitted the model with colorful pictures and all sort of interesting ideas, and he just had that passion and that vision for the project. So again, this isn't a commercial for Bill, but I will say anyone in Phoenix looking to have someone look at their rundown apartment building, Bill Tonneson was really good for us.
Well, he kind of gave the property a personality, like a it felt like it was just not another rental, not a place to just kind of hang out. It was a lifestyle. He kind of created that lifestyle.
Absolutely, and for Bill, he tied it into the Phoenix Art Museum beautifully, and we sort of ran with that because, as opposed to most landlords in that submarket who are, say, offering a month free on a 1-year lease with a tenant in that community, we didn't offer that. We held our prices higher, and we offered a flat screen TV in the unit installed, and we offered a year membership to the Phoenix Art Museum, which took off. We really saw great results with that, and we started attracting a whole new tenant base at that building. As you can imagine, when a building is run down and no one's taking care of it and it's a foreclosure, the people who live in those buildings still are, not necessarily the people you want living in your building. Some of them are paying rent, some of them weren't. So you have to clean house a lot of times when you come into an asset like that. And then once Bill got involved, we started adding that cool factor, and once we finished it, the tenants that we're attracting to that building now are so impressive, and we're really, really proud of that building. What I've skipped through, though, kind of skipped over, was Bill did the entire renovation over the summer last year.
Nice.
And that was a long, hot summer.
Yeah.
The vacancy, the property went down to 50 or less % occupied. It was basically a construction zone. Our existing tenants weren't really happy because who wants to live in a construction zone?
Yep.
By far, that was the toughest part. The building is master metered for electricity, so we were running a chiller all summer. No matter how many people are using a chiller, that chiller expense is still going to come into your expenses. So we were running negative cash flow. The project was a construction zone. We didn't quite yet see how it was going to be so cool, and Bill just sort of promised us, and every now and then he would do a nice sketch for us to keep us at bay. But that was probably the hardest part, was that whole summer, getting through that. But once it became close to completed, and like you say, the personality really came through, and once that personality came through, it attracted tenants who match that personality, someone who's artistic and likes a unique, quirky building as opposed to a standard vanilla building. So we've really attracted an interesting tenant base there, and an attractive tenant base. We really, they're good payers and good people to live with. So once we got through that and we had the project finished, Bill unveiled his sculpture, his statue, at the front of the project, and the project was renamed the Fountain Apartments from Coronado Gardens, which, Craig, that's not unusual for us to re-identify a project once we purchase it. That's more or less normal because, again, the affiliation being with a rundown former foreclosure where people say, oh, I used to live there, or know someone who used to live there, and just the name is enough of a turnoff when a property's gone through some distress and a foreclosure. So it would be pretty typical for us to re-identify a project. So we re-identified this with Bill's help as the Fountain Apartments, and Bill unveiled a new statue in front of the project. We had media coverage on local stations, and we still have on our property website, we still have that media coverage. If you go to thefountainapts.com, you'll see the Fountain Apartments and the media coverage and all of the photos in the gallery, and you'll get an idea what Bill did there, and we're really proud of it. So getting back to your initial question, because to wrap this story up, we are in the process of selling the asset. The asset looked great. We stabilized it from a 50% vacancy up to about 95% occupied. And since we own the building all cash, we decided to just put it on the market and return some capital to our investor base. And right now, the property, we received 7 offers on it, and we're getting ready to get a purchase agreement signed, and the return is certainly more than double what we paid for it.
So you basically found a property that was the worst looking property on the block. It needed some love, and you saw an opportunity to reposition the property to art enthusiasts, basically, and create a lifestyle around that property for like-minded people, and you were able to take your rents probably, I'm guessing you're 25% higher than the market?
Right. Yeah, it was about $175 to $200 higher per unit, and we did do on the interiors. We did some nice remodeling on some of the units that the tenants really seem to like. And as we sell the building, as we're selling it now, one thing that prospective buyers come in and look at is they can see that we didn't turn every unit. We left a little bit on the table for the next buyer. So, we turned about 25% of the units there out of the 43-unit project. But the template is there. All you need to do is duplicate what we've done, and you can see your rents will generally go up about $200 per unit. It's funny because I heard when I first started listening to Value Hand Academy, I was listening to Jerry Fink,
right,
of the Bascom Group, and that was something he said, and I guess I had never given it quite as much thought, but his comment was, you want to leave a little bit of room and a little bit of value add for the next purchaser to execute their vision and do what they need to do to create value. And I really agree with what Jerry said. And so we decided not to convert and renovate every single unit in the property, just enough to where the track record was there, to where we could show what rent increases take place, what the costs were to remodel that unit, and then still leave 75% of the project for the next owner to do.
Yeah, because the next owner's got to go to his investor pool and show an opportunity, and you're basically giving them that opportunity, and they plug in their pro forma numbers with the higher rents, and therefore basically pay a little bit more for the property.
Right, you're right, and they will pay a little bit more for the property, and the initial return might not be great, but it might not be as good as you'd like to see, I'll say, but what you can see is that within 12 months you can see how you're going to start hitting your pro forma. And so anyway, I do appreciate what you did there in your interview with Jerry, because it is something we took to heart.
Yeah, he's a very sharp guy, and for those that haven't listened to his interview, you need to listen to him, because their Bascom Group is one of the top 20, some of the top 25 range as far as apartment owners in the country. So, and they've got started just the same way that you got started, Pat, and I know you're going to be following their footsteps.
Got a long way to go.
Yeah. Well, I know there's lots of real estate brokers and other service providers who actually, they dream about what you're doing. You took the risk, you went out and you did it, and you kind of got your business going. What kind of advice can you offer others who might be apprehensive to get in the game?
What I would tell those people is that you've got a tremendous advantage because you're already in the industry, right? You're in the industry. You're not a dentist or you're not a warehouse worker. You're in the industry. You're making loans, somehow involved in transactions, rehabbing projects, managing projects. If you're somehow involved in the industry, you've got a big leg up in terms of expertise in order to locate that good deal. Kind of rule number one, find a good deal. You've got the expertise to do that, and you've got the credibility with people because they know you are in the industry and that you have a flow of deals that you're going to see every day, and you've got access to expertise to help you through the things that you don't know. You'll be able to get referred to a good real estate attorney. You'll be able to get referred to other vendors who can help you underwrite and operate a property. So you've got a big leg up if you're already in the industry. So again, my advice would be, think positively about your situation. You're in the industry, you're finding deals, believe it or not, you're halfway there. So, all you need to do is work hard, get educated, prepare, and then source those good deals And like we said, let as many people as you can know about it, act with integrity throughout the entire process, and you're already ahead of most people if you're already in the industry. So don't let the silly fact that you've never done it before stop you.
Well, it's funny you say that because you're so right that they're right in the middle of the game, and they have some experience, they have some power to go out and talk to people about putting a deal together, but they don't seem to have that confidence.
Right. You just have to take that first step. That would kind of be my advice to anyone who hasn't done it yet, is you have to take that first step. You can't be stopped by something you haven't quite done yet, or otherwise you wouldn't do anything. So you need to take that first step and get going.
Well, let's talk about a few lessons. You've been through a journey here over the last number of years. What are some lessons that you've learned along the way that's really actually helped you with your investment business? We've
learned a lot just in the last 4 years. And, the adversity, the tumultuous market we've been in for the last 4 years, the housing crisis and everything else that we've gone through, the economy, that's been a learning. I mean, that's a graduate degree right there, the last 4 years, in terms of lessons. I still go back to early in my career in the early 90s when the RTC crisis was going on in Southern California. And, a good piece of advice that I received back then from a fellow CBRE colleague was just, we were all grinding through a difficult market and surviving and just getting through it. And the advice he gave me is that this uncertainty that we're in, the adversity that we're trying to overcome, and the failures, deals were, failing right and left, that everything we were going through, Craig, was helping us become better. And it was going to be valuable to us in future years. And I agree with that. That's probably the lesson, is that failing on a deal, learning from failure, learning what happened, just in the last couple of years, learning deal workouts with lenders and all the adversity that many owner-operators have been facing. You learn so much from adversity, uncertainty, and deal failures, probably more than just a string of successes, to be quite honest. I think the failures, the challenges that all of us face, whether you're experienced or brand new in the industry, those challenges help you become better. They help you become more focused, more creative, more committed because you're working so hard on it. And all of those attributes are what you need to succeed in this industry, good times or bad. So, in fact, when the good times come, they almost seem too easy in some cases because, you've gone through the difficult times. So I think that number one lesson, and a very important lesson, would be that the market we're in right now with adversity and uncertainty, that the failures that will inevitably come your way, deals fall apart, that happens normally. Those are really valuable experiences for someone starting out, and believe it or not, they're going to make you stronger, they're going to make you better, and they shouldn't keep you from, again, taking that first step, writing that first offer, doing that first market survey on your idea, what you want to approach in terms of a product niche and an area niche, making those first calls to find out more about it, what's working and what's not working. I think if you can get through that initial barrier, you're on your way.
I hope you enjoyed this interview. For more information on Patrick Wakeman and CALCAP Advisors, please call them at 858-764-4890 or visit their website at www.calcapadvisors.com. For any other questions, comments, or ideas, please email me at craig@valuehuntacademy.com.